We're going to be talking about shaping the next phase of digital assets. Joined by me is Darius Sit, QCP, Armani Ferrante, Backpack Exchange. We've got Kian from DBS Digital Exchange. Now, maybe give a quick 30-second introduction to the audience. Maybe start with Darius, please.
Sure, thank you. I'm Darius. I'm the founder of QCP. We are Asia's leading digital asset trading partner. We help clients with investment and hedging solutions in the digital asset space.
Hey everyone, my name's Armani Ferrante, founder CEO of Backpack. We are a self-custodial wallet. We are a global derivatives exchange and a group of 10,000 mad lads all around the world. Thanks for having me.
Hi, I'm Kian. I'm the CEO of DBS Digital Exchange. We set up in 2021. And we are the world first bank-backed exchange. And DBS is behind the DBS exchange.
Awesome. We've got a mix of TradFi and crypto-native exchanges on here. Now, first question, what was the aha moment that kind of got you guys building in the crypto space?
So I started in the crypto space in 2016-17, doing just arbitrage trading. My background is similar to Kian. I was a currency trader and particularly in Asian currencies, which saw liquidity dislocations and created arbitrage opportunities. So that was the aha moment for me, realizing that it's very similar to other asset classes in terms of liquidity and market structure. So I saw it as a very frontier asset class, and the opportunity that I thought would be is the evolving market structure, and that's what we've captured, right? So when we started, it was only spot trading, dislocated liquidity, but it has gone from frontier asset class to emerging now to something more of a mainstream asset class, and I think it will continue to evolve as well, and that's where the opportunity continues to be.
Awesome. And Armani?
Yeah, for me, the aha moment was pretty simple. It was, I was sitting at Phil's Coffee on Market Street in San Francisco, read the Ethereum white paper, got nerd sniped, and haven't looked back since. The concept of a world computer is perhaps the most compelling and ambitious thing for a young engineer to want to work on in early 2017. And yeah, that was really kind of the moment. It was definitely Ethereum and the promise of this global distributed system operated by everybody and owned by no one.
Awesome. Red-pilled by Ethereum.
Yeah.
And Kian?
So similar to Darius, I was trading FX, and cryptocurrency has the word currency behind, and I thought, I think it's in my territory to meddle with it and to know how to trade in it. So we set up a project group, and we study what's going on. I think what I was really intrigued by it is the blockchain technology behind it and empowering it. So with that, I basically feel that this blockchain technology will be the next frontier backbone for our financial markets itself. So, all the advantages that comes with blockchain, be it the 24/7 atomic settlement, be it programmability, transparency, and immutable data, all these will be the feature for future of our financial assets. And that got me really, really excited.
Yeah, and I guess for DBS as well, you guys are a traditional finance, it's a bank, you've got a custody arm, now you're managing the exchange arm. From an institutional client perspective, what's the most surprising attitude you've seen from them towards crypto?
So from where we see the clients, I think we have set up not only with the exchange, we have the custody, we have the customer-facing group, which comprises of the fixed income financial institution group, the private banking group, and the institutional group. So all in all, this will form our digital asset ecosystem, and that's where we service all our clients. And right now, our institutional and institutional clients, and we have private banking clients on our exchange. If you look at the institutional clients, we are comprises of crypto companies, exchanges, OTC traders, at the same time, miners and sovereign wealth funds. So we have on top of it, we have brokers that is using our platform. So we have a wide series of client base that's currently using our platform.
Yeah, and I definitely think with the private banking distribution that you guys have, it's So a diversified customer base that might not be able to kind of tap into a crypto native exchange such as like a Backpack. So with exchange space is very saturated at the moment. Like, how does Backpack differ themselves, and how is it? What moat do you guys provide?
Yeah, it's a great question. It's 2025, and who would have thought that a new exchange would pop up on this side of the world in the most saturated and the most competitive exchange market in the world? Maybe for some context, we've done over 70 billion in volume over the past 2 years. Today, we're doing about 2.5 billion in 24-hour trading volume across spot and derivatives. You know, when we launched in 24 and 25, and when we set out to build the exchange in 23, what we really wanted to build was that really incredible cross-collateral, cross-margin experience that I think a lot of people saw and loved out of FTX. And so we were really the first exchange in a post-FTX world that went live with this in terms of like all the new exchanges that launched. And we took it actually a step further, where not only do we have spot margin, borrow lending, perpetual futures, all cross-margin and cross-collateralized into a single unified portfolio, but the portfolio is also backed by a real-time, transparent money market. So your entire portfolio is earning yield while earning collateral or acting as collateral for your kind of derivatives portfolio. And so for folks that really care about capital efficiency, and they really care about cross-margining, we found a lot of traction amongst those pro traders. And so I really think it boils down to kind of that cross-margining experience. And you tie that with the wallet, it's a pretty compelling all-in-one kind of unified Apple-like experience where we don't treat the wallet any differently than we treat the exchange. It's a single app, it's a single login, where you can get access to any asset, any app, any protocol on any blockchain, whether you're a trader looking for kind of a capital efficient margin system, or you want to use like the rich burgeoning on-chain DeFi economy. And so that's what we have to offer, and yeah, that's kind of a bit of a product.
Yeah, abstracting that away and trying to make it a more seamless user experience. And for Darius, QCP is a major player in the options and structured market space. What are you seeing more appetite for hedging or speculation? What does that tell us about where the market is also headed?
Yeah, it's a good question. I just realized I'm the only person on the panel that's not from an exchange. Yeah, the space has evolved over the last 8 years I've been in it, and it's gone through many cycles. I would say that for us, the few visible things that demonstrates the evolution of the market. One is the volatility of Bitcoin itself. So if you look at Bitcoin itself, in 2018 probably it was about 200 to 300% implied vol, and the implied vol had a huge premium over the realized vol, meaning that the options market was very new. A lot of the flow was very speculative, and a lot of the flows were, I guess, not professional traders, right? So people who are looking to express directional views. So that 200-300% vol has slowly declined to 40 vols, so 200% to 40%. That's a demonstration of the maturation of the asset class. So it's a result of changing behaviors, right? So the investors and participants in the space go from being speculative to chasing yield, hedging, as well as putting on more, looking at risk reward rather than pure convexity. So I think it's also a demonstration of the types of players that have come in. So like you mentioned, more institutional players, less speculators. You have, like Kian mentioned as well, sovereign wealth funds, miners who come in. So that's a very key part of the market structure. Another interesting part of the market structure is the forward curve. Back in the day, pre-2020, the forward curve was in backwardation, meaning that the future price of Bitcoin was below the spot price, and that's a function of guys selling, miners mining Bitcoin and selling their hedging their positions forward. But right now you have it the other way around, right? So it's an expression of both, I guess a bit more similar to gold, where there's a cost of carry of it involves. But yeah, so I think the market will keep evolving, and I think the key thing that would make it bigger, I guess, would be the growth of proper credit. I think that's something that exchanges have a big part to play, banks have a big part to play, but a credit market where you have a proper curve with bonds trading, credit trading, I think that's what's going to happen going forward.
Yeah, that's an interesting point, actually. I think when we're talking about macro as well, with rate cuts coming in, money supply is going to increase, M0. We saw this post-COVID, and that drove on risk assets, huge influx of interest going up the yield curve, as well as going out, pushing out into that risk on mindset. Do you think DeFi summer is going to be back? And who do you think are going to be the beneficiaries if it does come back? If we will start with Kian.
I think crypto assets will be similar to the traditional assets. You will go through the cycle of bulls and bears. To me, I think what's important is that you have the right market liquidity and the right instrument for you to manage your risk. And most important of all, you must have the right platform, a trusted and safe platform for you to invest in. So to me, every investors need to navigate crypto assets like any traditional assets where they have all the bull and bear market cycles.
Yeah, we definitely learned a lot post FTX in keeping your assets safe. Maybe Armani on whether or not DeFi summer is going to be back.
Yeah, it's a great question. I mean, I think it's impossible to say. The industry has obviously become night and day difference between now and where it was in summer of 2020. I think we went from obviously an extremely stringent and onerous regulatory regime in the US that kind of set the tone for the entire world to swinging to the other side of the spectrum. And there's continues to be a ton of progress with respect to not just various regulatory regimes around the world, whether it's in Japan where there's a bunch of tailwinds, taxes are going to go from 55 to 20%. So that's kind of the expectation. Crypto is going to get reclassified into a new regulatory regime. The prime minister is now going to crypto conferences, and we're seeing a lot of what we saw in the US start to happen there.
That's some out for the audience if you're not listening to what Armani just mentioned.
Do your own research. This is all kind of speculation, but it is an expectation. In the US, obviously, you have a ton of progress on the policymaking side of things. Obviously, you have the stablecoins having their moment, the Genius Act coming into play, and now this whole conversation around market structure, where there's this open question of what does it actually mean to be, in DeFi? What does it mean to be a centralized exchange or a decentralized exchange? What does it mean to issue assets and tokens and to build protocols on all of these blockchains that have popped up around the world over the past decade? You see perp dexes having their moment right now. You see all of this in the midst of, you got to call a spade, mania, which is what we're seeing today. I would argue we are in DeFi summer 2020 right now. And it just might not feel that way already. There's plenty of crazy stuff that you're going to point to and ask, wow, that doesn't really make sense. And you kind of scratch your head. And the world is very much on pause at the moment while some of these policy questions become answered, where we know we swung too far to one side of the spectrum. And we know that was net very, very negative for the industry and for the broader world. And now we are in this collective journey as a set of nations and as a collective species and collective consciousness, depending on how abstract you want to go, as we wrap our head around what the implications of crypto and blockchain and internet capital markets actually means. Because with every new technology, whether it's financial markets kind of in the early 20th century, whether it's the internet, whether it's crypto or AI, the world needs to wrap its head around it and figure out how do we harness this for the outcome that we want. And right now, we're certainly in the middle of figuring that out. And once you get some of these policies kind of in place, once you get some new legislation in place, and you get some of these things actually defined, then entrepreneurs, regulators, founders, people in the space actually know the rules of the road. They know what are the constraints that they can operate in, and that ultimately is what unleashes creativity and it unleashes growth. And so I think right now it's kind of like, it might sound silly to say, but I kind of feel like we're all chickens with our heads cut off. Everybody's kind of like running around and innovating as fast as possible. But as soon as there's constraints, productive constraints applied, then I think we'll see a lot more directionally productive growth in where we want to go. So it's a really special time. I think it's a really precious moment for everybody in the industry, and it's not exactly DeFi summer, but it's directionally kind of rhymes in various ways.
Yeah, it doesn't really feel like the DeFi summer that we had back earlier in 2020, 2021, but history doesn't repeat itself, it might rhyme. And Darius?
No, I think seconding what Armani said, DeFi summer is here, but probably in a different way. Maybe less speculative, less hype. But if you look at the volume on perp dexes, if you look at the volume in DeFi credit, it's larger than it's ever been before in multiples, right? So I think Aave hit like $30 billion in TVL or something. I mean, it's large and much larger than it was in the previous DeFi summer. What I think is happening is that the definition of DeFi will start to change, as alluding to your point as well, as the lines between DeFi and CeFi start to get blur. And what do I mean by this? You're going to start to see DeFi expand more than just DeFi or CeFi in crypto assets, but into traditional assets. As equities get tokenized, as more and more assets get on chain, you're going to see DeFi methods of margining, DeFi methods of settlement, DeFi methods of trading being applied to assets across the entire spectrum. So that's what I mean by it will be, the definition will change from DeFi to on-chain settlement, RWAs, but DeFi will be expanded across asset classes. So DeFi will no longer be a crypto-native specific thing, but it will be a concept that is applicable to TradFi as well.
Yeah, we've taken a lot of whatever's happened in TradFi and just tokenized it. And I mean, money market funds, these kind of concepts. And tokenization itself is such a buzzword. So I think we can, what do you think about that? And is there any traction? There's tokenized bonds, real estate, etc., all these kind of assets, but are we seeing institutional buy-in yet?
Well, the key question to ask is, what's the problem to solve for? So to me, if the real world asset is trading in a manner that customers are happy with, then there's no need for us to tokenize the assets. So when we look at a product, we always ask ourselves, what do our client needs? So if they want an instant settlement, is that what they want? Or the product in the real world itself, does it give them any pain points? So to me, if we are serving the needs of a client, and client demand is there, that is the area that we think that tokenization will make a lot of sense. Hence, we work on tokenized money market fund, because we feel that this tokenized money market fund, if it is denominated in a stable coin, that will allow the digital asset player to actually buy tokenized money market fund with their stable coin when they don't need the stable coin. And as it is, stable coin has no yield. And they can earn some yield before they decided to sell the money market fund token for the stable coin itself. So to me, I think that is where the demand side is. And we work very hard to try to put the product forward. At the same time, money market fund is being tokens are being seen as a collateral ecosystem. So funds and institutions are actually using money market fund tokens as part of collateral basis. So to me, this is the area where there is demand and structurally it solves a lot of problems, as collateral need to be posted sometimes during Saturday and Sunday. And you need to post a collateral on the 24/7 basis. So it itself will solve a real world problem. At the same time, we are also looking at private shares, tokenized private shares. For that, I think a lot of our AI clients, in terms of private, illiquid private shares, unlisted private shares, these type of investments are not accessible to them in the past. Most of these investments are more accessible to the institutional investors. So we are bringing this to the exchange to be distributed to our clients. It itself can be fractionalized, and the clients can actually trade and sell off part of their investment in a smaller amount, hence better manage the market risk itself.
Yeah, it's definitely about capital efficiency and being able to borrow against your assets using that as collateral. You've seen that with even though tokenized GPU, so private credit kind of markets within the GPU space as well. That's been growing. I'm going to switch channels a little bit from a regulatory arbitrage perspective. I'm Australian. I moved and left to Hong Kong for tax reasons. And over the years, I've seen different crypto companies trying to look at that regulatory arbitrage and moving from the US over to Singapore, Hong Kong, Abu Dhabi, Dubai. Is that regulatory arbitrage, does it still exist? And where do you think is the most attractive place for builders and people who are setting up crypto companies?
Early in the life of the company, when we decided to take a regulatory path, we actually asked this question, right? Where's the best place to get regulated? What's the journey going to be like? I think our thesis was that eventually every jurisdiction is going to be regulated. So the decision about where to get regulated became more of a sequencing decision, meaning like which regulator is more progressive or suits the business better, but with the thesis that eventually everyone's going to be regulated in the same way at some point. So the way we approached it is, number one, get regulated in Singapore, because I live here, and I want to continue living here. And also Singapore had a very specific regulation around payments, spot trading, and it was clear. Extremely difficult. It took us like 5 years to get regulated here, but eventually when we get it, it becomes an anchor for that segment of the business. The other place that we decided to get regulated in was Abu Dhabi, ADGM, because for us it was interesting because they saw crypto as part of the broader capital market, meaning they didn't see it as a carve out. So it was a license to get to be able to do everything: Bitcoin, FX, rates, equities, all together, which matched how we saw crypto as well. And these are the two anchors for us. We've opened an office in New York, and I think we're going to explore regulation there too. Given the vibe change and some of the additional clarity there. So again, it's more of a sequencing thing than arbitrage specifically.
Yeah, definitely. And I guess Armani, you're based over in Tokyo, Japan. Is there a particular positive headwind that you're seeing there that's coming out?
Yeah, it's a funny question because we moved to Japan for the exact opposite reason of regulatory arbitrage. We moved it precisely for the purposes of being next to the regulator so that we could get the license. I think I'll say this, that I think there's various forms of thinking about regulatory arbitrage. There's where are you domiciled, and how can I build a really good relationship with a really progressive regulator to actually push the space forward and do the right thing. And then there's also regulatory arbitrage in the sense that, you're on the bleeding edge of technology, or you're at the edge of the Overton window, or the world's wrapping its head around a thing and it doesn't really know exactly what it actually means and the rules. And regulations aren't defined yet as a result. And I think as crypto continues to grow, and as the on-chain economy continues to grow, and as more centralized and traditional regulated players come into the space, as these worlds converge, we are in this momentary period of, to put it uncharitably, regulatory arbitrage, where we are just figuring out exactly, what this all means, right? Real-time settlement, cross-collateral, not just crypto assets, but what happens when you start throwing securities into the mix? And I deposit in my Apple stock and I withdraw dollars. And now I have an open borrow open with real-time settlement for anyone to use around the world. And these are really compelling technologies for genuine steps forward for modern finance. And I think regulatory arbitrage can be thought of through a negative way, and there certainly are negative aspects of it, but there's also a lot of very positive aspects of it, which simply you can look at it through the lens of just innovation. And whether it's Uber's taking over taxi cabs or crypto eating all of finance, I think you can look at it through a similar lens. And so there's a ton of really compelling new things being built in different parts of the world, and it'll all kind of shake out hopefully on average in a positive way, but that's kind of my framework for thinking about it.
Yeah, and I guess
would like to add on Darius' point. I think to me it's a matter of a strategy for the company. If QCP sees the value and wants to serve institutional clients, they will see the value of getting license, taking the trouble to apply for license in a reputable jurisdiction and financial hub like Singapore. And he will go through the tough effort and the time taken and resource taken to get the license. Whereas some companies where they are unable or unwilling to invest that time and money, they will look for legislation. They will look for jurisdiction where it better suits their strategy. So I think it's a matter of a strategy.
Yeah, I mean, Singapore and Japan are difficult jurisdictions you could argue, to get regulated in. And I guess all you guys have chosen these difficult jurisdictions for a reason, and it's not necessarily an arbitrage, it's getting the right regulated approach way through so that your customers can also benefit. Just quickly on time, so maybe in one sentence, what's the biggest crypto misconception that people around you always see? In one sentence, just very quickly. Darius?
I think people misunderstand crypto as a speculative asset class. I think that the real disruption of crypto is on the settlement and margin layer.
Amazing. Armani?
Wholeheartedly agree. I think the other thing I would say is a lot of people think of crypto as a solution looking for a problem, when, in my view, crypto is purpose-built technology to improve financial systems all around the world. And as a result, we're going to see crypto not only apply to crypto assets, but we're going to see it apply to all of finance in every corner of the world. And that's very clearly the direction the whole industry is going in.
Perfect. And
so for me, I think market prices, the wrong assumption is that market prices are basically related to technological advancement or the ecosystem adoption. So you must understand that market prices are based on narrative and liquidity of the market and the flows in the market. It may not have anything to do with the blockchain underlying and the technology advancement underlying. And that may take many market cycles for it to reflect on the price.
wonderful. And that's it. Last panel of the day. Thank you to our panelists.
Thank you.
Thank you.